Well, thanks, Bill, and thanks, Nate. I really appreciate that. This is part one of two for the quarterly market report. And so on Friday of this week, we'll do part two. But part one is going to be about a lot of things that have already happened and hopefully some context around that. And the headline for this is the bounce that nobody expected. And so there is this truism in this industry that sometimes it is the client that is paying the least attention that might do the best and might honestly have a little bit less stress. And as I'm about to show you here in the timeline of events, if you just haven't opened your statements or gone online in the last 6 months, you might not know that anything had happened. So we're just going to kind of walk through this timeline here and talk about what's happened. So Bill mentioned that it's been a little bit of a stressful time this year, and I'll just remind you about the lead up, which was actually a lot of people felt like we were a little bit in the doldrums in the last half of last year. And then all of a sudden there was this news that was emerging around the end of the year, the beginning of this year, about this new virus. And the market tended to kind of just trudge on for a while after that. This is the global equity index we're looking at, but it didn't take too many weeks before the market had an extremely severe reaction. A lot of legitimate concerns, fear running rampant. What is this going to mean as the pandemic took hold? And you see in this chart that massive decline that actually set a number of records for just how quickly value went out of capital markets. Not just in stocks, I'll mention, which is what this is a graph of, but also within other riskier assets such as corporate bonds and junk bonds in particular. But we do see a V shape there at the bottom, which coincided with a number of programs from the Federal Reserve and the Treasury. The headline here being that the Fed cuts rates to near zero and launches their corporate bond buying program. And then despite the economic news, things began to rally back. And while this chart ends on June 30th, things have continued to rally back since then. And so we're kind of back to what had honestly been a high point, not even where we were 12 months ago, but the high point before things went down for many parts of the stock market. And so when you look at that long-term chart inset on this page, this was definitely enough volatility to register. But if you just look back at the other big dip you'll see, which was the Great Recession, where it took longer to go down and longer to come back. And I mean, we thought that was a sharp V. This is really unprecedented in terms of the depth of the decline and the speed of the rally. And so that's our tortured history for the last 12 months. Now, if you look at the blended benchmark results table, and this is something you will have also seen if you've gone on to the Client Care website and taken a look at your second quarter portfolio report, what you'll see when looking at the indexes is that really, except for sort of one column there, you wouldn't have hints of the real stress that the market has been under. We didn't have a time period that coincided exactly with the bottom, but if you look at the year-to-date numbers, you get at least a hint maybe of the fact that this has been a tough year. If you go to the one-year number, nothing is negative. You go to the three-year numbers, that's pretty reasonable in the 5% range. And as you go farther out in time, the 10-year averages, which of course is capturing a big part of the rally, you'd have no hint of the stresses that we've been under. Now, normally at this part of the presentation, if we've had a little bit of market dip, I might quiz people. Do you remember the market dip of 2006? Do you remember the market dip? And I'll just roll through, half a dozen market dips that seemed like a big deal at the time and ask if anyone remembers. And usually people don't. Usually in a room full of 20 people, one person might remember a particular market dip that, again, was a big deal at the time. I do have a feeling we're going to remember this one, even if the market has recovered at this point. I think we'll all remember what was going on in 2020. not just for what happened in the market, but what it's meant for the broader economy, which definitely has not healed. As we start to go through a more granular view of the asset classes, we see all our green arrows there, and that's for the past quarter. So that is the bounce nobody expected. And I keep saying nobody expected. I don't know. Maybe there was somebody that said, hey, we're all gonna go back to where we were in about 3 months at the worst of it. Not many people thought that. Now, at our firm, BIP Wealth, we were, for most of our clients, buying stocks because they were below their long-term risk tolerance. So for many of our clients, we were buying on the dips. We even had a number of clients called in to say, I want to make sure you're buying on the dip. Unfortunately, we did have a small handful of people that sort of couldn't take it and bailed out, and they got the downside and didn't get the recovery. But, we have just had a tremendous bounce in every risky asset class, and indeed every safe asset class, when looked at in the bigger picture here, had a fantastic quarter. The reason that the risky asset classes had a great quarter was because the Fed and the Treasury made comments about infinite money, which I've never heard before, and whatever it takes, which I don't think I've heard before either. And so we really continued a trend that was firmly established back at the depths of the Great Recession, that it was the federal government's job to come in and rescue the capital markets. Capital markets have become so important. The stock market is such a pervasive part of society that it's not just about rescuing the economy. The belief is that you need to rescue the capital markets for the economy to do better. People buy homes with their stock market portfolio, as an example. So the capital markets appear to have been rescued. The safer assets, fixed income and things like that, have had a big bounce because interest rates have declined. And I'm sure most of you remember the way that works. When rates fall, every piece of fixed income out there is worth more as long as it's secure, because whatever rate you'd locked in is now even better relative to where the market is. So we've outlined some of the best and worst quarters. And this year we set a new best quarter. This is looking back roughly 2 decades for the U.S. stock market. 2020 Q2, the new best quarter for the U.S. stock market. And that's all the large and the mid and the small rolled up together. We also set a worst quarter for international developed market stocks in Q1, down 23.3%. So we have pushed the boundaries of what both the good and the bad look like this year for several asset classes. Going through lots of other information, we're going to just show you about everything we know here. The point we're really making here with this chart of the major market index returns, and this is a chart we don't normally show, but if you went through and matched up what did well in the second quarter, it pretty perfectly maps to what are the riskiest asset classes. The riskier it was, the better it did. So again, for anybody that tried to dial back their risk at the worst of it, they missed some of this. Most people know that emerging markets and the smaller companies, emerging markets tend to be the riskiest. Well, they did the best. And I'm not going to read out all those asset classes, but if you go down to the other end, cash, 1 month treasury bills, you got a 0.02% return in Q2. So it was a risk on quarter, as we say. Q1 was a risk off quarter, risk got pummeled. Q2 was a risk on quarter, risk did the best, and the riskier it was, the better it did. Going through the different parts of the market as we normally categorize them for you, and looking at the U.S. stock market, what we see was that small cap growth did the best. And generally speaking, small caps did better than large caps. Small caps are generally riskier. Now, 1 quarter does not make the year-to-date number go in that direction necessarily, nor does it for the 1 year and the 3 year, where large cap growth technology stocks have tended to be the best place to be. but small caps were definitely the place to be for the quarter. And the U.S. has done relatively better than most other parts of the world, which means that now the U.S. stock market is 57% of the global total, which is kind of amazing to see. We were down to 45% just a few years ago. Now we're up to 57%. Look at international developed market stocks, which is now 31% of the total, and that was approaching 50% of the total again just a few years ago. We're showing you in the top right quadrant there what the quarter looked like, and we're giving you two numbers, and that's based on the currency that you were investing in. Now, I think everybody on this call was investing using dollars, right? You put dollars in your accounts that we're managing here. And so you get the darker gray bar, which is the bigger set of numbers. So that's kind of nice to see. Again, small caps did the best. So for this quarter, you benefited from an overweight to small caps. But the currency translation effect played a role. So the US dollar actually flipped. Or another way of saying that is the currency that you were invested in when you own international stocks did better. It appreciated. So this quarter, at least, you got the benefit of those foreign currencies appreciating against the dollar, and you got what those markets did unto themselves. So in most cases, the currency effect added about another 3% or so to the returns for the quarter. We see a similar trend with currency, of course, with emerging markets. Foreign currencies tended to appreciate against the dollar as investors turned a little bit sour on the U.S. on, let's just say, a relative basis because of the pandemic. And again, that's the opposite of what happened in the first quarter, so it's kind of evened out. But we saw some pretty good looking numbers there for emerging markets, with small caps again doing the best, which was really the global trend. If you were invested in US dollars, then that's roughly a 27% return for the quarter. Emerging markets are only about 12% of the global equity index, and just a little bit less in terms of how we invest, because we do have a bit of a home market bias, as you might say. We're a little bit invested more in the U.S. and a little bit less in these foreign asset classes than if you just bought the global market. Looking at the different countries out there in the relative performance, we've got those stacked by developed markets and then by emerging markets. A few things jump out. One is the U.S. was not the best place to be, and certainly not the worst place to be, and that is almost always the case. Usually, as I'll show you in another slide in a moment, currencies are a big part of this. The other thing to notice is that the spread amongst countries, in between countries and emerging markets, was and almost always is larger than the spread amongst the developed countries there. But there was a commodity boom, and that led to a lot of the rally in Australia and New Zealand. The UK is still laboring under Brexit uncertainties, and so that held that back a little bit. But the U.S. was near the top of developed market and would be ranked near the top of emerging markets as well. And there's the currencies that I was talking about. And these currencies for both developed and emerging markets are how they did relative to our currency, relative to the U.S. dollar. For so many of these slides, what the market did as a total, which countries did the best, which asset classes did the best, it's almost just the opposite image of what I was showing 90 days ago. So 90 days ago, I was showing you charts where the US dollar did better. Here I'm showing you charts where almost everything did better relative to the US dollar. If you put those together, we're almost exactly where we were on January 1st. So here you see all these currencies, and in particular, the Australian dollar appreciating against the US. But again, this is just more or less the opposite of what happened in the first quarter. Looking at REITs a bit, not a bad quarter for REITs. And to be honest, I'm a little surprised that REITs are as low as they are in their year-to-date numbers. If you look in the bottom right quadrant, you definitely see that the year-to-date numbers are not fantastic for REITs. So we didn't get the bounce back there that we might have elsewhere. Now, this type of REIT index isn't including single family housing and some of those other parts of the market that many of us would be more familiar with that have actually done pretty well and more or less bounced back or even grown year to date. What we're capturing here is probably some uncertainty around what might be an excess supply in certain parts of the real estate market. Now, we don't know how this is going to play out, but we may have all learned how to do business via Zoom and by using more technology and being in person less. So it might be, for instance, that Class A office space is not going to have the demand that it had, and certainly there were lots of projects in the pipeline adding to the supply, but it might be that not as many people are going back into the office because of what we've had to learn using Zoom and other technologies. Sometimes when interest rates fall, certainly if they fall as severely as they did, REITs will act a bit like fixed income. They tend to have a high yield, and so you get a real rally. And we've seen that off and on as rates have fallen for the last year, but it was not nearly enough of a tailwind in the second quarter to make up for what I think are probably some doubts about certain parts of the real estate market that may be under pressure because of changing work habits and an overall slowing economy. Getting into commodities just a bit, definitely would be another one of those charts that looks like a flip from first quarter. You see unleaded gas with a 70% rally, but I might not be the only one that took a picture on my phone and sent it out to friends at some point, standing in front of a gas pump where I just couldn't believe that gas was, barely over $1 per gallon. So unleaded gas there is the wholesale gas known as RBOB before the final chemicals are added in before the oxygenate blending occurs and so on. It was at the bottom last quarter. It's at the top of this quarter. And of course, crude oil and some other things there did the same thing. Now, we have had some rallies in precious metals, which is not uncommon when there's some uncertainty. One of the most unpredictable parts of commodities investing, and not something that we put our clients' portfolios into. In fact, we don't have an explicit commodities allocation at all anymore because commodities on the whole are really there to hedge against inflation risks. And we're not too worried about inflation at this point. Now moving into fixed income, where we've seen some very dramatic movements. And a year ago, I thought interest rates were low. One of the things that we talk about in our investment committee conversations is something that in our industry is abbreviated as the ZLB, the zero is a lower boundary assumption. And we've seen a lot of sovereign debt markets, the equivalents of treasury bonds around the world, actually get into negative yield territories. But we've not seen that in the U.S. Maybe these low rates point to that as at least a possibility. But a year ago, when cash was paying about 2% and longer term bonds were paying a little bit more than that, we had this kind of saddle shape to the yield curve for treasuries. We thought rates were low, and we were certainly worried about the devastating effects to fixed income portfolios if rates were to rise. But hey, we were all happy to be able to make a couple percent in their bank accounts and by holding cash. Well, that's all gone. Not much really happened in the last quarter, but now cash is pretty much back to zero. Whatever teaser and promotional rates might exist out there probably aren't going to last for long, and then cash everywhere will pretty much be at zero. And you can make a commitment to buy a treasury bond and hold that for 30 years and, be guaranteed right now that you'll get paid, 1.2, 1.3, 1.4% per year for 30 years. That's just how cheap the yield is. And part of that is just because globally investors flock to the U.S. to buy these bonds. So it's actually a very cheap time for the federal government to borrow. They barely have to pay investors to get their money. So maybe that's a good thing. If you look at what did the best and the worst year to date in the chart below, you'll see that high yield bonds have had a bit of a rough year. And fortunately, our investors aren't exposed to those here. And we've also just highlighted the long bond index, which is one of the riskiest parts of fixed income, but that owns those 30-year bonds. And so year to date, that number is nearly 21%, which is kind of amazing. Now, if interest rates blip up just a little bit because we have a vaccine, things start to go back to normal, it would be easy to lose 20% in 6 months in that index as well. So again, stock market like risk, but probably not a place where we're going to see stock market like returns going forward. Again, a 30-year bond right now yields about 1.3% per year. And here's just a chart to support a little bit of what I was saying before about the state of rates in the 6 biggest sovereign debt markets all around the world. The U.S. in the top left there is still positive. Bits of the UK are negative. Bits of Japan are negative. Most of Germany is negative. But Canada and Australia are holding their own and being positive. So if we were ever to go negative, I'm not sure how much more stimulus that could possibly provide. You're near zero already. But a lot of things do get weird when rates go negative. And so I'm not sure I'd say that I'm a proponent for that. But we'll just say that borrowing costs for government quality debt are extremely low right now. So if you need to borrow to do something, it's pretty cheap, as many of you would know if you've looked for a mortgage lately. And then we're kind of cruising into the end here, and just wanted to make a point. This is actually a repeat slide from 90 days ago. And the question that we posed, and the question many of you ask yourselves is, how far will the economy slide? So I would offer that that is a relevant question for a whole bunch of people. Certainly if you're running a business, it's a very relevant question, although it depends a great deal on what type of business you're running. Not every business is being affected the same way right now. But I would also suggest that despite all the headlines, the things you read about that, the legitimacy of that question for many reasons, that is not actually the question that you should be asking as an investor. We just had one of the best bounces in history. For anyone that had become pessimistic about the situation we're in for your own personal health reasons, for economic reasons, we get it. But the stock market has already come back. And the reason that happened is because the stock market, as we think we understand it, is a prediction of the future. And so nobody can ever write the perfect headline to explain why the stock market has done what it's done. But I would offer this very simple explanation. The stock market believes that, at least on the whole, we're going to get through this. The stock market believes perhaps that there will soon be a vaccine. The stock market believes that there will be value unlocked as we return to normal. And so that's already priced in. So the stock market doesn't tend to think about these things for a long time. If there's a belief that that's what's going to happen, the price moves almost instantly to reflect that. So it may be years before the economy has, in the aggregate, returned to normal, but the stock market has already come back from what was a really rough first quarter. And it's an amazing thing to see. The academic community is going to be talking about this for years to come. And as I said before, I think it's something that we're all going to remember. So as investors, for that limited scope of conversations we'll have, we're going to talk about the markets more than we're going to talk about the economy. They are two different things. So just a quick reminder here, where are the opportunities? I'll run through this and then I think we're done, except Nate may have some compliance slides to show, but just a quick thing. Don't exceed your risk budget. For folks that didn't exceed their psychological risk budget coming into this year, they dealt fairly well with this dip in the recovery and the buying opportunity it presented, but you want to stay at that. And I think most people are ready for that conversation. Obviously, stay diversified. You never quite know where the winners and the losers are going to be. These 2 quarters back to back are the perfect example in many ways, where what was the loser in first quarter became the winner in second quarter. And of course, don't judge short-term results. We have a psychological tendency, many of us, to take whatever's happened recently and draw a straight line through that and say, well, that must be the future. What if the stock market goes down 40% every quarter? I mean, that's not the way the market has ever worked before. It would be a mistake to think that it's going to work that way now. And in that sense, don't lose faith, because ingenuity, entrepreneurialism, the human spirit are what ultimately drive the markets. Of course, buy low, sell high, which is the program you're all on if you're with us. And consider private market deals. Now, this is something that I'm going to get into in the second part of this on Friday about where the specific opportunities going forward. But just keep in mind that there's a lot of exposure to small and entrepreneurial companies that occurs in private markets, not just in the public markets. Yields on fixed income tend to be much higher in private markets than in public markets. And to be truly diversified, you probably need that exposure if you can afford the illiquidity, if you have the income or the assets where the SEC rules say you're allowed to even invest in the private market. So with all these things in mind, and I know probably everybody has concerns and doubts, I just remind you to ask questions. You have, each of you, an advisor that cares deeply about your outcomes and would want to do everything they can to make sure that you get what you want and get what you deserve. So that's all about having a dialogue. So don't forget to ask questions. And